Okay, so today we are going to talk about the Smart Investors Playbook. Uh, the people who actually achieve success in investing, what do they do? What do they do differently? There are many people who start to invest and then maybe they lost on one investment or the other, they just pull out and they stop investing. Then other people hear of such experiences and they don't even venture into investing at all. So today we are going to talk about the things that people can do so that they can achieve success in investing. So that's why I tagged it the Smart Investors Playbook. And we're going to be talking about the strategies. We'll talk about taxes and growth. So we'll start with the problem and then we'll start talking about those three things I just mentioned. Then I'll talk briefly about Ivorian Financial. Now, the I always when I meet with people and I talk to them about investment, there's an analogy I always give that there are three pillars of investment. There are three pillars that determine whether or not somebody is going to be successful when it comes to investing. And those are what to buy, when to sell. I tell people if you get one of them wrong, you are not likely to be successful in investing. So those are the three main pillars. I still stand on it. However, as we all know, when we build a house, if the house is standing on some pillars, there are certain things that make the pillars to be strong. There are certain things that help the pillars, so that help the pillars to be able to be strong and to carry the house. For example, the pillar must have a strong foundation. You don't just put the pillar on the surface of the ground, right? You let the pillar go deep, right? And also the materials you use to make the pillar, and so a few other things can determine how strong those pillars are. The same way, when it comes to investing, I've mentioned those three pillars. There are certain things that must be done right for those three pillars to work well. You know, most people just think that, okay, investing is about picking the right stock. Remember, I said the first pillar is what to buy, right? Now, people think that once they pick the right stock, that's it. That automatically guarantees them success in investment. But that's not just it. That's just the foundation. You must make sure that every other thing is done right, apart from investing in the right thing. So in reality, long-term success in investing, apart from buying the right thing, buying at the right time, selling at the right time, it also depends on what strategies you use. Your strategy will determine what you buy. It will determine when you buy, when you sell it. It also the time success in investment. It's also determined by taxes. How you manage your taxes. This is one way where many people who invest by themselves don't get it right. First of all, some people don't even understand that they have to pay taxes on the returns that they get in investment. And years later, if they ever get audited or IRS gets to know one way or the other, there will be a big issue. There will be a big issue. Every year that you invest and you have returns from your investment, be it in terms of realized capital gain or dividends or something else, you need to pay taxes on it. But there are ways to be smart with taxes. There are ways to pay taxes, to organize your taxes efficiently, which is one of the things we are going to be talking about today. And the last thing is growth. How do we ensure that our portfolio's growth? And one of the ways is your ability to stay consistent. We'll talk about all of those things. So those are the three things we are going to focus on today. Let's start with strategy. Under strategies, there are a few things that we need to consider. What I would say is one of the most important things we need to consider when it comes to strategy is diversification. Now, we know that stock market or the price of a specific stock is not just on a straight line. Like it goes up, it goes down. It's the forces of the buy and selling that determines the prices or the price of a specific stock. But beyond that, besides that, some other factors can affect it, like, okay, maybe the interest rate, maybe political factors, and so on. So now, when you invest in a specific stock, there are risks associated with the entire market itself. And there are also, those are called systemic risk. There are risks associated with the specific company that you buy. That is called non-systemic risk. You have to make sure that you minimize your risk. Now, you don't want to take buy and invest. In fact, there's no investment that does not have any risk, And I'm going to talk about shortly, I'm going to talk about how in risk and return relate, So, but the most important thing is that you have to be diversified. What do I mean by diversifying? Meaning that if you have a portfolio of stocks now, you have to make sure that some of them could have lower risk while some of them have higher risk. So that means that, let's say the price of one goes down, maybe at the same time the price of another one goes up, right? So you are able to balance the portfolio. Now, many people don't get diversification right. They just think that, okay, let me just buy. I hear people saying, oh, all I just need is to buy index fund. All I just need is to buy mutual fund. Those are good, but they have their drawbacks. You think that, okay, because index fund, mutual funds, they are a basket of goods or a basket of stocks, right? That they are automatically diversified. Not necessarily. It just depends on the kind of mutual funds or index fund that you buy. Now, let's consider a mutual fund that has, let's say, 100 stocks. It may or may not be diversified. Out of the 100 stocks, maybe the concentration is on just 10 of them. Maybe just 10 of them have the sum of allocation of the 10 of them out of the 100. Maybe it already carries 50 to 60%. That means if anything happens to one of those 10, let's say the price goes down, or something, the price goes down, it's going to affect that mutual fund more than the ones that have lower percentage. So when you're buying index on mutual fund, even ETFs, you have to look at the asset allocation to determine whether or not it is diversified. Another perspective is also that, okay, if you buy, you don't want to buy just one mutual fund in your portfolio and think it is diversified. You can buy that one mutual fund, maybe you buy some other mutual fund, or maybe you supplement it with individual stocks to make the entire portfolio diversified. Now, let's go into the different ways we can diversify our portfolio. The first one is a diversification across asset classes. In the next slide, I'm going to talk about asset allocation. So this is about maybe in your portfolio having stocks, having real estate, having certificate of deposits, and so on. So that, let's say something happens in the stock market, you still have other assets that you can fall back on. You don't want to put all your money in stocks. I love stock. I always advocate for it. I always tell people, invest. But you do not want to put all your money in stocks. In actual fact, it is recommended that before you begin investing, you must have what's it called? Emergency fund. That one is very, very important, because if you start investing without having an emergency fund, what's going to happen is that if emergency comes up, you may need to go sell your stock. And that may not be the right time. Maybe the market is not doing well at that time. If you are, then you are forced to sell it, you sell at loss, and then you think that the stock market investment in stock is not good. No. So you make sure you have your emergency fund that you can fall back on when there is an emergency, and then you now have different asset classes that you invest in. You don't want to invest in just one asset class. Then the other one is diversification across sectors and industry. So in the stock market, when you're trying to do research as to, okay, what to buy, you see that stocks are grouped into sectors and industry, even sub-industries. You don't want to put all your stocks in the, let's say, financial services industry alone. No. If something happens there and then most of the companies are not doing well, your portfolio, the value of your portfolio is going to go down. Neither do you want to put all your stocks in, let's say, energy. Right now, because of what is going on in Iran and all of those things, some energy stocks are doing well. And if you say because of that, you go put all your money in energy. By the time the war is over, there's a good chance that the prices of those stocks could come down. And then the value of your portfolio is down. So you want to make sure that you strategically select the industries that you want to and sectors that you want to invest in. And it is better to select the industries that are negatively correlated. Now, for people who have done a little bit of mathematics, you understand what I mean by correlation. When you have two items, if they are negatively correlated, that means, for example, in the case of stocks that we are talking about, when two companies are negatively correlated, that means when the price of one goes down, the price of one comes down, right? So you want to make sure that when you are getting when you are deciding the industries that you want, that you want to invest in, you don't want to invest in industries that are too similar. If they are too similar, then you are not really doing um, any good diversification. Another thing is diversification across geographical location. Yeah, most people will just buy stocks within the United States. But we all know what has been going on in the past few months or 1 year or so. One day there will be issue with tariff. One day there will be issue with war and all of those things. And sometimes the market is not doing well. In order to diversify, you want to make sure that you buy stocks of companies like not just in the United States, you buy foreign stocks as well. Now, this can be done in two ways. You can actually invest in stock markets outside of United States. Like, okay, you go invest in London Stock Exchange and all of those things. The only drawback with that is that, let's say you want to go invest in London Stock Exchange, you have to buy the stocks in pounds. So you have to go change exchange, go to exchange, go change the currency, right? Now, another way you can do it rather than going to invest directly in in another stock exchange is that there are foreign companies that list in American Stock Exchange. You can buy them. There could still be exchange rate risk, but I can say that the risk is a little bit lower. You don't have to go register in London Stock Exchange, for instance, or go register in another stock exchange. Within America, there are foreign companies that list. So the advantage is that if something happens with companies within America, maybe the foreign companies will be doing well. So that's another way to uh, to invest in stocks. Then, to diversify. Then another thing is the market cap. When we talk of market cap, we are talking about the values of company, meaning the number of outstanding stocks multiplied by the market price. So, according to market, companies have been grouped into like, okay, large, medium, small. So, as you're buying companies that that have large market cap, you may want to supplement it with medium market cap. You may want to supplement it with small market cap as well, so that you are able to diversify. Then the last one is different companies. You don't want to buy just one company. That's like putting your egg in one basket. If something happens to that company, your portfolio is going to be affected. For example, I have at least 3 companies that I invested in, and their stock value has become 0. That means I can never get the money back. If I had put all my money in those those 3 companies, but I'll be in trouble today. So you want to make sure that you buy multiple companies rather than just one company. This is especially important for people who work for companies that have stocks, and maybe they're able to buy at a cheap price. Like I used to work for a company that they would give me 15% discount to buy their stocks, and yeah, I did buy some of them. So if you have such opportunity, you don't want to put all your money just because you are getting discount. You don't want to put all your money in that one company. If anything happens, it's going to drag your portfolio down. So it's really, really important to make sure that you diversify your stock. And that is what will help you. If one company is not doing well, another company will do well. And it will not drag your portfolio down so much. Then another strategy which I mentioned just a little bit in the previous slide is asset allocation. You don't want to invest in just one asset. Like I said, you don't want to invest in only stock. You can put majority of your stock money in stock, but you should still have other assets. So this is not an exhaustive list. There are things that are not in this slide, but these are some common asset classes that you can invest in. You can invest in stocks, you can invest in real estate, gold, bond, certificate of deposit or share certificate, and cryptos. You want to make sure that you invest in at least 2 of these. For example, most of the time, when stocks are doing well, bonds may not do well, and vice versa. Gold, stock and gold as well. So if you have in your assets in multiple, your money in multiple assets, is going to help. When one goes down, the other one goes up. And now let me talk briefly about gold and cryptos. Gold, if you want to invest directly in gold, when you buy it, you have to store it somewhere. And that's an additional cost. Because if you just buy it, you put it in your house, know that in America, there are things that you go, for example, you go buy a new car today. Next week, you get something in your mail that some people are trying to get you to subscribe to a radio, or you just purchase a new house. Next week, some people, you get an email. Some people are trying to get you to buy insurance or something. Most of the time when you buy something from a company, they sell your information. So if you go buy gold now, where the company that sells to you could, I'm not saying they will definitely, but they could sell your information. And if you just put the gold in your house, it could be stolen. So you have to store it somewhere. That's an additional cost. Rather than doing that, you can invest in gold indirectly. For example, there are gold ETFs. I have gold ETFs that I invested in. So rather than me investing directly in gold, I invested in their ETFs, and I'm able to benefit from the increase in price of gold. The same thing applies with cryptos. Rather than me buying cryptos and then having to put it in a wallet or something. Moreover, crypto is really, really volatile. But rather than that, I have crypto ETFs. So I just thought of noting that one. Another strategy is having a balance between risk and return. This is something that many people may not do well. They don't want to take risk and they expect to be able to get a lot of return. It doesn't work that way. If you look at it and you consider only this line, the higher your risk, the higher the return. The lower the risk you take, the lower the return. So if you are the person that wants to preserve your capital and you are trying to take, you are trying not to take too much risk, you will also not get much return on your investment. To get much return, you have to take more risk. And I have put asset classes, different asset classes here in with respect to their risk and return. At the bottom here is cash and CD. You put your cash in your you put cash in your account. Maybe even maybe savings account. Maybe you get 0.1% APR. Let's even say that it's a high yield savings account. These days, you will hardly not find any bank that will give you more than 3.5%. You know, that's still nothing. You know, now bonds could give you 4%, 5%. You know, then if you buy like okay some balanced mutual funds, maybe they will give you more. I talked about market capitalization earlier. Large cap stock might not would not have as much risk as small caps. Those are established companies, but at the same time they may not give you as much return as small caps. Then international stocks, you know, they carry a little bit more risk, but they also give you more return. And then you look at alternatives. Alternatives are things like gold, like ETFs, and all of those things. They are more volatile, they carry more risk, but they carry more return. If you look at gold, you know that gold has had wild run this year. You know, although in the last 1 month or thereabout, it hasn't been doing well. But if you look at the year overall, it has run a lot. So yeah, you try to balance your risk and return. You try to determine that how much risk am I willing to take. That will now determine the asset class that you are going to invest in. And even within an asset class, the different things that you invest in could have different risk and return. So you write down your goal and then determine how to balance both. And one more thing, when it comes to retirement, I always tell my clients, when it comes to retirement, you could like, okay, stocks could be something that you invest in if you're still, let's say, far away from retirement, let's say 30, 40 years, you can put a large percentage of your portfolio in stocks. But when you are nearing retirement, you want to reduce the percentage you put in stock and now increase the percentage you put in the items that have lower risk. Now, these next two strategies could be a little bit difficult to explain, but if you use them well, you are going to you have a good strategy for your investment. Please give me just a moment. I'm trying to. It's getting hot here. I'm trying to. Okay. So now I said these next two strategies could be a little bit difficult to explain. I'm just going to summarize it to actually explain how they work really well. We'll take maybe a whole session for either each of them or the two of them together, but they actually work. They work really well. The first one is dollar cost averaging. Now, dollar cost averaging, what it's all about is investing the same amount regularly. Whether or not the market is doing well, you still invest the same amount. So the market is up this month. You invest, let's say for instance, in this visual that I have here, you decide to invest $500 every month. So when the market is high, it takes more money to buy a single unit of that stock, right? When the market drops, it takes less money to buy the same stock. So whether the market is high or the market is low, you still invest the same amount, 500 in this case. But when the market is high, you buy fewer shares because it takes more money. That's why this you can see it takes more coins when the number of coins there is more than the number of coins there. That means when the market is high, because it takes more to buy a single unit, you actually buy fewer shares then. When the market drops, it takes less money to buy the same unit, and because you are still spending the same amount, you buy more shares. So you keep doing that every time. It doesn't have to be every month. It could be every pay period that you just decide the intervals. It could be every 2 months. You decide the interval that works for you. So just invest the same amount every year. And for people that have like workplace retirement, one way or the other, you are doing so, because when you have what's it called, for instance, let's say your each time you get paid, you already set a percentage of your income that goes into your retirement account. What happens? Let's say every pay period, again, let's take this $500 for instance. Every pay period, they deduct $500 from your account to invest in stocks. What happens is that when the market is high, they buy fewer units of the stock. When the market drops, they buy more units. You are putting the same amount every time. So one way, if you have retirement account, indirectly or known to you, you're already doing that. But it's also good for the accounts you are managing yourself. It's also beneficial to do similar things. That also helps you to be disciplined. So now, what's the effect of dollar cost averaging? The effect of dollar cost averaging is that your average cost is lower than the average price of the stock you are investing in. Again, that may not be very clear until I actually demonstrate it. Maybe one of these days we can have a session on dollar cost averaging, and I will go into more details to explain how it works. But the most important benefit of dollar cost averaging is that you have lower cost than your lower average cost than the average price of the stock that you are investing in. Now, let's go into the other one that is similar to that. That is value averaging. For dollar cost averaging, I mentioned that you put the same amount every period, right? This is the opposite. You don't put the same amount every period, but rather you want to maintain like a certain value average for your portfolio. Like you want your portfolio to increase by a certain value every period. Let's say you want your portfolio to increase by, let's say, $100 every period, right? That's why this line represents the growth in your portfolio. And as you can see, it's a straight line. So that line, it's a steady growth. You have a steady growth. So again, what happens is that when there are certain times that you actually when the value of your portfolio is below the target, the place where you want to be, you actually invest more. When the value is below your target, when the value is above your target, then you invest less. That's why Here you invest 700 because the value here is below your target. You invest less. So this is the value of your what's it called? This is the value of your portfolio. It's below your target here, so you invest more so you can reach that target. But when your when your portfolio has now increased a little more, you still invest, but you invest less than you invested in the previous period. So let's say you invested 700 in this period. Now that your portfolio has risen a little bit more, you now invest 600. If your portfolio rises even more, you invest 400. It rises even more, you invest 300. Now, the drawback of this approach is this. There could actually be a period that if you want to, like, okay, make sure that you stick to it the way it actually works, there could be a period that, let's say there's a boom in the market, your portfolio rises beyond your target, you may have to sell it. This approach is good when you have a goal. Let's say you are trying to invest to pay your child's school fees. You have a target that you are trying to attain. And if your portfolio now rises above that target, maybe you think that, okay, let me sell it and put the money somewhere else. So that's the drawback, that you could actually have to sell it if your portfolio um, rises above the target. But again, it has an advantage that it helps you to stay aligned with your growth goal. You have a goal of how much you want your portfolio to be increasing every period. By doing value averaging, you are able to stick with it. You are able to align with that goal. You understand? So, and also it keeps you consistent. So that's the end of the strategy. We've talked about different strategies that can help you to grow your portfolio. Now we are going to talk about taxes. Again, I think it's important for every investor to know that when you invest in any asset and there's a growth, maybe capital gain, maybe you get dividends or something, as long as you have income, Uncle Sam is going to get out of it. So what you want to do is to make sure that you manage taxes efficiently so that you don't put too much of your income does not go into paying taxes. You want to retain as much of that income as possible rather than paying everything, right? There's this thing concept called, these two concepts called tax avoidance and tax evasion. Tax evasion is wrong and can land you into trouble. You don't want to evade tax. You must pay tax. And this is something that many people don't understand. Many people think that they invest, they get return, they keep everything. No, it doesn't work that way. So if you've not been paying taxes on your investment, you need to actually start doing that. You get 1099. Every stock that you invest in at the end of the year should give you 1099. As long as you have a return of more than $10, you use that 1099 to file your taxes. If you file taxes yourself, include that. If you give your taxes to somebody else, give the person your 1099 to be able to file taxes with it for you. Going back to the two concepts I was explaining, tax evasion is good. I mean, it's bad, rather, can land you into trouble if you don't pay taxes. But there's something called tax avoidance. Contrary to some opinion, tax avoidance is legal. There are ways to avoid taxes, or at least to minimize the taxes you pay. That's why you see billionaires, and you hear that they are paying $7 in taxes because they know how it works. The Congress has put in loopholes for people, especially billionaires, people who have a lot of money, who can afford to give their taxes to very good accountants. They know how to avoid taxes. But you may know, by the grace of God, every one of us will be billionaires. But even right where you are, there are strategies to avoid taxes. And not just that, or to minimize taxes, but not just that. The most important thing is to be as tax efficient as possible. So how do you become tax efficient? The more first thing is to be able to know, as far as taxes are concerned, to be able to know how to have balanced portfolio. A balanced portfolio is a portfolio that has assets in these three asset classes: taxable accounts, let me start with tax-free account, taxable account, and tax-deferred account. You should have your investment in these three accounts. One of them is not good enough. Make sure your portfolio in these three accounts. The proportion may be different. So now, what do these all represent? If we start with tax-free account. Tax-free account is an account where you put your money and your money goes tax-free. You invest in it, and when you get your money, provided that you abide with certain rules and regulations guiding that item. When you invest in it, and you get your money back, you don't pay taxes. An example is Roth account, be it Roth IRA, Roth 401k, and so on. Anything Roth, by the time you take your money out, you withdraw your money, it is tax-free. You are not going to pay taxes on it because you use the money you already pay taxes on. That's why you invest in Roth. You invest post-tax. You already paid taxes. Any growth, for example, I put $1,000 in a tax-free account. Any return I get from it, let's say now my $1,000 grows into $1,500. I'm not going to pay taxes on the $500 growth because it's a tax-free account. Any Roth account. Another kind of account that could be tax-free is municipal bonds. Now, municipal bonds, for all municipal bonds, you don't pay federal taxes at all. If you now buy municipal bond in the same state where you reside, you are not going to pay taxes. If you buy it in the same city where you reside, you are not going to pay city taxes. So if you buy municipal fund of your city, you don't pay city tax, you don't pay state tax, you not pay federal taxes. That is especially good for people who have high tax rates. So municipal bonds, what's it called, Roth accounts, your money grows tax-free. The next thing is tax-deferred account. For tax-deferred account, an example is your 401k, 403b, SEP IRA, and so on, traditional IRA. You invest before you pay taxes. So right from, for example, if you are doing 401k at your place of work, before they deduct taxes from your account, they invest for you. They take out the money that should be for your retirement account. So you don't pay tax on that. The implication is that your money grows tax deferred. That means even if, let's say it's a traditional IRA you are managing yourself, even if you sell stocks, you have return on it, as long as it's still on in that traditional IRA, you don't pay taxes, you get dividends, you don't pay taxes now. Your money grows tax deferred. So your money, you have more money that is able to grow rather than tax free, right? Because you have not paid taxes on it. But the implication you have is that when you retire and you withdraw money from your account, you are going to pay taxes. So, yeah. Then that is good. Now, anyway, let me talk about taxable, and then we'll talk about how do you determine, like, okay, what to invest in all of this and what proportion to invest in. The last one is the taxable account. An example is the regular brokerage account. Every year that you have returns in a taxable account, you must pay taxes. And your taxes will come be in form of like, okay, you have capital gain. For example, you invest $1,000 in, let's say, Palantir, for instance. Let's say after 1 year, your $1,000 becomes like 1,200, and you sell it. The $200 that you have is the capital gain. You are going to pay taxes on it. You get dividend. You invest in a company that pays dividend. You get dividends. You pay taxes on it every year. Now, capital gain again. Maybe we'll have another session that talks more about um what's it called, taxes. Capital gain, the taxes you pay on capital gain depends on how long you owned it. Capital gain, you might pay capital gain taxes or you might pay ordinary income taxes. Please give me, somebody has been trying to call me. Please give me just one moment. I'm sorry about that. I sent somebody to do something for me and she just got me. So anyway, the taxes you pay on capital gains could actually be capital gain taxes or ordinary taxes. Ordinary taxes is the tax you pay on your income taxes, right? But capital gain taxes is lower. But it depends on the holding period. Because of time, we've already spent 41 minutes. I'm not going to go into much details of that. The same thing with dividend. Dividend can be qualified dividend or non-qualified dividend. If it's a qualified dividend, you pay capital gain taxes. If it's a non-qualified dividend, you pay ordinary taxes. But again, yeah, and that will determine the amount you pay. We'll go some other time. We'll go into more details on taxes. What you want to make sure you do is that a portion of your um, portfolio should be in each of these because each of them has their pros and cons. And there are some that okay, you can't just withdraw anyhow. You withdraw unless you meet certain rules or guidelines. You are going to have penalties. Apart from paying taxes, you have penalties. But there are some that you can withdraw, you can do anything you want. So you must have a balance between these three. Still on taxes, transaction value. You buy today, you sell tomorrow, you buy another one the day after, you sell maybe 2 days later. Each time you sell stocks, you are paying taxes. So to reduce taxes, you have to reduce transaction volume, meaning how often you transact, how often you buy and sell. That doesn't mean that you cannot take advantage of, let's say, fluctuation in the market and maybe go in, go out. You can still do that, but you have to go do it strategically. You have to make sure that you don't just do it haphazardly. Just take note that each time you buy and sell, there are taxes. Foreign stocks, I mentioned earlier that you can diversify with foreign stocks. When you buy foreign stock, you are going to pay foreign taxes on it. Although when you file taxes, the foreign taxes you pay could actually reduce the capital gain taxes you have on US what's it called, US stocks. Then I mentioned earlier, I'm not going to talk too much about it. Non-qualified dividend. Non-qualified dividend, it will be treated as ordinary income. I will explain in some other session. I will explain the difference between qualified and non-qualified dividend. But just take note of all of these that could affect the taxes you pay. Then mutual funds. People talk about, oh, I just want to buy mutual funds. I don't want to take too much risk and buy what's it called, individual stocks, and I'm not buying ETF. I want to buy mutual funds. Mutual funds are not as tax efficient as ETFs. What happens is that you may not sell your mutual funds and you will still incur taxes. Like I mentioned, both mutual funds and ETFs are baskets of stocks. But with mutual funds, when there is a company that is actually buying individual stocks, they issue the mutual funds, they are buying individual stocks as their asset. When they sell and they realize gains on those stocks, that gains will be shared on a pro rata basis between all the people that own the mutual fund. So you may not sell your mutual funds, you are still going to pay taxes because some underlying stocks in the mutual funds have been sold and they are realized gains. So for me, I have a few mutual funds, but I invest more in individual stocks and ETFs because of the taxes. So just take note of that. Then growth. It's important to note that time in the market and consistency, they matter more than trying to time the market. What do I mean by timing the market? Timing the market is when you are trying to say, oh, the market, the stock market, I mean, the price of a specific stock will go up tomorrow. Okay, let me buy today so I can take part of the stock, a part of the gain, or it's going to fall tomorrow, let me sell it. By just going in and out, then most of the time you may not get it right. And that is something I tell people who just sell anytime there is a downturn. No, you don't sell at that time. It's important to always be in the market. Time in the market and being consistent. Decide how often you want to invest, be it every month, every pay period. The consistency and the time in the market helps your portfolio to grow a lot than time in the market. Now, compounding. Compounding is something very, very important. And that's one of the reasons I always tell people to invest. So this is how compounding works. When you invest in an asset, you invest your money in an asset. Give me just a moment. Somebody's trying to get in. Okay. You invest in an asset and you get a return. Your asset, let's say for instance, you invest in $1,000. After like, okay, 1 month or a few months, you have a return of, let's say, $20. Your $100 has become 120. What happens is that for the next period, your return is not going to be based on the initial $100 that you invested. No. Your return will now be based on the 120 that you now have. What it basically means is that when you invest in an asset, the return or the interest you get from it in turn gets more return. So again, you invested in $100, it became 120. The next pay period, your return will be based on the 120. Let's say you now get you get additional 25, it becomes 145. The next pay period, your return will be based on the 145, not the previous 120, not the previous 100. Compounding is a very, very important force when it comes to investing. And it's also one of the reasons you want to make sure you stay in the market. So compounding helps for long-term growth. I cannot overemphasize this. You have to stay in the market. We know what is going on. The war in Iran. You could wake up today, your portfolio has gone down, let's say $2,000. And you could think that, okay, the war is going to be for a long time. Let me withdraw my money. You withdraw your money today, you wake up tomorrow, you hear that the administration has declared ceasefire, then the stock market rises. You want to buy back, you will not buy at the same price that you sold your investment. Moreover, you are going to pay taxes on the ones that on the return that you already have. So it's always important to stay invested no matter what is going on in the market. Now, I don't mean that, okay, you should never ever sell when a stock goes down. Now, if it's the entire market that is not doing well, I would say never sell. If it's one company that is no longer doing well, and you know you've done your due diligence, you've done enough research, you know that that one company is not likely to survive it, it's better to get out of it as soon as possible. So whether or not you stay in a specific stock is determined by your outlook, your future outlook of that stock. Whether or not you believe it's going to revive and how long will it take. But if it's the entire market that is not doing well, it's better to stay invested. Having said that, let me introduce you to Ivorian Financial. I have explained the different things that could help your portfolio to grow. We looked at the different growth strategies. We looked at how to either avoid taxes, which is legal, or how to reduce the taxes that you pay. We've looked at how you grow your portfolio. But let me tell you one thing. It takes a lot of time and effort to do all of these things. Can you do it yourself and make profit? The answer is yes. But not everybody has enough time to do all of this due diligence. Not everybody has enough knowledge to be able to do all of these things. Some of the things I explained, I just gave summary, especially like dollar cost averaging, value averaging. I did not give you an example because of time, you know. So yeah, why those strategies are good for you to be able to do them, and you have to actually have time to do it, and get more knowledge and go into details. Again, maybe we'll have a session where I go into details. But for people who don't have enough knowledge or who don't have enough time, Ivorian Financial is here to help you. At Ivorian Financial, we offer different services. We do financial planning. How do we make sure that you don't run out of money in retirement? How do we make sure that you have enough money to pay for your children's school fees? That goal of maybe going on vacation, how do you know we make sure that you have enough money to do it? How do we know make sure that you are sufficient, you are financially free? We take a holistic look at your finances to help you out, and we recommend the things you do. Then we do investment management. We help people to invest in stocks, bonds, CDs, and so on. We personalize this. We don't invest the thing for everybody. We work with you to determine, based on your goals, your values, and your risk appetite, we decide what you should invest. We help you with taxes. There's something I forgot to put under taxes, and that is tax loss harvesting. How can we ensure, how can we reduce the taxes you pay at the end of it? I do that for my clients, and I do that for myself as well. At the end of the day, I do tax loss harvesting so that I reduce the taxes I pay. We do all of those things. Risk management will help you manage the risk on your portfolio so that you don't take too much risk. At the same time, we want to be sure that you take enough risk to be able to have a good return. Then we help you with retirement planning. We help you to plan your retirement to make sure that you have enough money to live in retirement. So yeah, we are independent. We don't have any association with any of the big firms, and we put our client first. We are a fiduciary. By a fiduciary, I mean that your interest, we put your interest first, and we personalize everything. So we work with you. We work with long-term growth. We help you to manage your portfolio, and then we apart from that, another thing I did not mention in the services is we organize a seminar like this one that we organize today. But we don't just do days. We organize seminars uh, for churches, for different organizations. So if you belong to an organization, you are trying to encourage people to invest, trying to show them to invest. That's something that we can organize for you. So if anybody is interested, I'll be happy to schedule a session with you, tell you more about what we do, Then thereafter, there's another session called discovery session that we organize to know more about your finances and to be able to tell you how we can help you. Thereafter, we analyze the data you have given us to determine the different things we can invest. So we now create a plan for you, and then we implement the plan. We don't stop that. We monitor. And if there's a need, maybe depending on what is going on in the market, there's a need to adjust, we do that. So that is what we do at Iverian Financial. Thank you everyone for attending today's session. In the next few minutes, I will take a question. Any questions you have, any thoughts you have, please feel free, unmute yourself and share. Questions, thoughts, anything. Anyone, please feel free to.
Yes, sir, for the presentation. I just wanted to ask more about the uh, tax. There's a way you put it. You said tax. It's different from tax avoidance. I mean, tax avoidance is different from tax evasion.
Yes.
So my question is about this tax avoidance. It's is when you itemize your taxes as opposed to using standard IRS deduction, is that one way to do like a tax avoidance? And also with investment, how does, itemizing your taxes, your tax deduction, doing an itemized deduction, sorry, and this investment, your investment portfolio, how does that come into play? So my first question, when you itemize your deductions, is that one good way to avoid, if you're able to itemize to exceed the standard deduction? And also when you have an investment portfolio, I believe my question is itemizing the way to go so that you can also use your buying and selling activities in your investment portfolio to include in the itemization.
Okay. That's an excellent question. So, I talked about tax avoidance, that okay, you avoid paying taxes or you reduce the taxes and it's legal. You do it in a legal way. You do it based on the tax code, based on the different deductions that Congress has made available. That's different from tax evasion. Tax evasion is that you're supposed to pay taxes, you refuse to pay. That's that could lead to problem. Now, how standardized deduction, how does it play with tax avoidance? Now, standardized deduction may not be for everyone. So usually for me, each time I file my taxes every year, I file taxes for my household every year. And with each year, I check tax, what's it called, standard deduction from against itemized deduction every year, and I'm able to pick which one is better for me. For some people, standardized deduction is the way to go. For some people, itemized deduction is the way to go based on certain deductions that they can have. For example, you give to church or some other non-profits, and if you give a lot, that could help you uh, to reduce your taxes or to avoid taxes. Uh, if you, let's say, maybe you have some, um, what are the other things? Like there are some things that you can actually list rather than itemizing them that can help you to reduce taxes. But if you don't have much deduction, standard deduction could be good for you. So you just do like I do, you just compare the two. Coming to the second question, the using standard deduction or itemized deduction does not affect you managing taxes on your investment. Whether or not you use, it doesn't matter which one you use, you still, as long as uh, you pay taxes, you need to enter the information from your 1099. But now, irrespective of whether you use standard or itemized deduction, there are ways you can reduce it. I can tell you this last tax that we filed for my house, for my household. I'm not going to tell you. I was supposed to pay IRS a lot of money. I'm not going to say how much, but by the time I did standard deduction and I did tax loss harvesting, they actually gave me money back rather than me paying them. So when you have tax loss harvesting is something very, very important that you have to make sure you do, you know. And the good thing about tax loss harvesting, in short, tax loss harvesting is like intentionally selling something at loss to offset the gain you have. And the good thing is that it can carry over from one year to another. You just need to make sure that you keep that information, you know. So yeah, you can still, whether you use standard or itemized, you can still manage your taxes so that you reduce your taxes or you even avoid it. And then in deciding between the two, try both and see which one gives you more money or which one will let you pay less taxes. Any other question? Questions, thoughts before we end
Yes,
this? Yes,
yes,
sir.
I have a question. Thank you very much for this presentation. I would like to know how we can connect with you to learn more about Ivorian financial.
Okay. Thank you, sir. You can, I'm going to put my number, my business number. Well, you personally, you have my phone number, my personal phone number. You can talk to me. I will schedule a session with you. I will give you more details about what we do, how I can help you. But for people, if there's anyone, I don't think there is actually anyone on this line that does not have my personal phone number. Yeah. So yeah, you can reach out to me on my phone or you can talk to me in person, and then we'll look for a time that is good for both of us. We'll have the first session where I tell you more about Ivorian Financial. Then, if you are interested, we have a second session called Strategy and Discovery Session, where I look at your finances just a little bit, and then I decide how I can help you. I give you more information. After that, you can now decide whether or not you want to go ahead. Yeah, so please just talk to me, sir, and then we can schedule a time that works for both of us.
All right, that
And
sounds good. Thank you.
you're welcome, sir. And for everyone on this line, if you saw the flyer I put out for this session, for everyone on this session, I'm going to do something for you. If you're already investing, I can help you look at your investment to see whether or not your portfolio is diversified. I'm not going to tell you what to buy or what not to buy, but I can tell you, I can look at it that, okay, this is diversified, this is not diversified, what changes you can make to make your portfolio better. I can do that for everybody that is on this call today. Please just reach out to me and we can schedule. It's a free session. I'm doing it free for everyone on this call. Yeah. Any other thoughts, any session before we sorry, I said any session. Any question, any thoughts before we end the session today? All right, if there is no um if there's no what's it called question, I'll stop the recording. I'm going to share